One of the most frustrating parts of selling a business is getting deep into a deal and then watching it fall apart near the finish line. Because at that stage, time has been invested, momentum has been built, expectations are high, and yet deals still fail at the last minute. Why? Usually, it is not because of one dramatic surprise. It is because risk, doubt, or misalignment has been building quietly beneath the surface and finally becomes too large to ignore. Let's break that down. One common reason deals fail late is diligence. What looks acceptable early in the process may become a problem once the buyer gets deeper access to the business. Financial inconsistencies, weak documentation, customer concentration, owner dependence, legal gaps, tax issues, operational risk. These things often do not kill a deal in the first conversation. They kill it when they are confirmed later. Another reason is unrealistic expectations. Sometimes the seller expects more than the business can support. Sometimes the buyer expects more certainty than the business can deliver. And when expectations are not aligned early, late-stage friction becomes almost inevitable. Deal structure is another major factor. A headline price may look good, but once terms are negotiated in detail, the gap between what the seller wants and what the buyer is willing to accept becomes clear. Earnouts, seller financing, working capital adjustments, indemnities, employment transitions, non-compete terms. This is where many deals start to strain. Financing can also cause late-stage failure. A buyer may appear committed, but if funding is weak, lender requirements change, or investor support softens, the deal can unravel even when both sides want it to close. Then there is process fatigue. Long deals create pressure. Deadlines move. Diligence requests expand. Emotions rise. And sometimes one side simply loses confidence, patience, or motivation before the finish line. Trust also matters more than many sellers realize. If responses are inconsistent, delays increase, or new issues appear late, buyers start to wonder what else they have not yet seen. Once trust weakens, the entire deal becomes fragile. And finally, some deals fail because the process was never strong enough to carry the pressure of the final stage. Weak preparation, weak communication, weak buyer qualification, weak control of diligence. These may not seem fatal early, but near closing, every weakness becomes magnified. The key lesson is simple. Deals usually fail late for reasons that started early. That's why strong preparation, clean positioning, qualified buyers, disciplined process control, and clear expectations matter so much. Because the goal is not just to get close to a deal, the goal is to get it closed. EIN Business Brokers. We represent you in business sales and acquisitions. Confidential, structured, executed.